You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, it's that time again. It is Education Wednesday time to roll out another episode of the old OBC. And if you're hanging out in the pro, bonus goodies for you folks, listeners. You're getting a double header right into your ear hole, smack dab. So I hope you're ready. I hope you're raring to go. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks are binging today, April 30th, as we're recording this, listeners. The final day to get your name in the hat for the Pro Trading Crate for the month of April. Trust me, you want to win one of these once, at least, in your options trading career. The only place to do so, theoptionsinsider.com/pro. That gets you in the hat to win the Pro Trading Crate, of course, to join our folks there who are getting the doubleheader. Right now, they don't need to wait a week. And then, of course, options oddities, all the other fun, early access to a lot of great content. Lots of fun going on. Theoptionsinsider.com/pro is the place to go to learn more. Like I said, we are recording 2 today because I will be traveling down to the Options Industry Conference next week in scenic and sunny Florida. So opening up the Southern studio again, listeners, but this time bringing a lot of people through it. You know what we do down at OIC. We bring on the broad spectrum of movers and shakers in the world of options and put their feet to the fire for you folks to figure out what the hell's going on in options, what you should be paying attention to right now and in the months and indeed years to come. So if you folks have a guest you'd like us to grill for you down there at OIC, or maybe just a topic or area of interest or concern you'd like us to discuss next week during our Southern Studio roundtable sessions, by all means, hit us up. Let us know. It is your network at the end of the day, listeners. You folks get to dictate what comes on it. So yet another reason to be subscribed to the full network. And joining me here on a little bit of the old Education Wednesday, he is a wee bit under the weather, listeners. So let's try to be nice. Let's try to be kind. Let's try to talk softly. He is none other than Dan, the black-hatted one, Passarelli from MTM. Mr. Dan, was that soft enough for your gentle ears, sir?
Oh, yes, that was very, very soft. The soft, smooth sounds, yes.
All right. We're making Dan do a double header, so let's see if he's up for it as we keep diving right on into a little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, time to dance. See a lot of fun talk there in our live chat about a lot of trading opportunities out there right now. Yes, there are, listeners. It is another wild market as we're recording this. So So hopefully you're having a good time out there. Hopefully you're trading well. Hopefully you're enjoying a little bit of the earnings season. And of course, the macro winds that are buffeting everything out there right now. We're on again, we're off again with the trade war. The economy not looking so great in some of the recent numbers out there. So a lot of that buffeting the market right now. But interesting stuff out there. Like, that's a good level. Who's that? I mean, that's a good level for those puts out there. Let's keep rolling. I'm getting distracted by the trades going up in our chat, listeners. Good stuff. But let's keep rolling on into our topic for today. Dan, an interesting topic that we've touched on tangentially when talking about other topics over the years, obviously, but never really shined a full spotlight on the show, is the notion of institutional options trading. How do the big institutions, the big players out there, how they utilize options, and maybe how it's similar and how it's different from your average 10-lot trader who listens to this show, Dan. When I say institutional versus retail options trading, what really leaps to mind to you, Dan? Maybe some of the similarities or differences.
Man, I think that first of all, you mentioned broad spectrum before when you were talking about OIC. There's full spectrum when it comes to institutional trading. To steal some CBD nomenclature here. Like with retail traders, you get retail traders who are brand new and some who have gotten pretty good over time. They all kind of do these retail type strategies. With institutional trading, you get stuff from, hey, we just do a little bit of covered calls, to, yeah, we do long short arbitrage, blah, 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 blah stuff. It's just such a big, long gamut when it comes to institutional traders that it means so many different things. It's just such a full spectrum from the simplest of strategies, but just trading with a lot of money, to very, very complex strategies.
All right, Dan, our chat is doing their best to distract me with juicy trades going up out there right now, but I'll leave that to them. We have a show to do. I sound like you now, Dan. We got the dings going on in the background trying to put up my trades, but I won't do that. I won't do that for the listeners, Dan. As you mentioned it, there is quite the spectrum there between the institutions and the retail. That said, I've said this many times to a lot of the people who come on our network and have worked with us over the years, the broad chasm that exists between your big fund and your 10-lot retail trader, it used to be an enormous gulf. These days, not quite as big of a gulf as it used to be out there. Obviously, for a lot of reasons. Retail, thanks to shows like this, but obviously also a lot of content that is available out there. Brokers doing a great job of educating out there. They're just more savvy, more sophisticated than they were a decade or so ago. So that's been a big change. The tools they use, their understanding of the options market, for a lot of the retail folks out there, it's going to rival, if not exceed, a lot of the folks that are managing the big desks out there, listeners. So that's been a nice change to see in the world of options. And I think we could take some small measure of credit for that. We have been doing this on the education side, on the podcast side, certainly the longest. And it's been a fun road to be on and just to see the evolution of the retail customer. So Dan and I will take a small modicum of a bow for that, listeners. But a lot going on in the world of institutions. A couple of obvious differences to hit first. Obviously, when you're talking about what the institutions, the bank rolls that they're bringing to the table, the account sizes, the size of the trades we're talking about, obviously going to be a lot larger than your proverbial 10-lot. And when you're bringing a lot more money to the table, it's going to open certain doors that just aren't there for the 10-lot mom and pop trader. If you call up a desk and you want to put up an options trade and you're a large fund or something like that, they'll go the extra mile for you. They'll make a custom market for you if you like. They will facilitate your order, which is they'll help you to get it done. They'll maybe take the other side of some of it at a price they don't really want to do just to make you happy because you're a big customer and you're going to bring a lot more paper to their desk as a result. That's why you see sometimes And it always gums up the works when we're looking at unusual activity analysis. You see a big fund selling options at a price that you and I never could. They're selling at or very close to the offer, and they're buying them very close to the bid. Why is that? Because they're a large fund. They're bringing a lot of contracts to the party. So the other side of that order, the desk that is trading with them, they will go the extra mile. They will facilitate them. They will take down a trade on their own offer or bid if they have to, just to make that customer happy. Guess what? You click the mouse button for your 10 lot at your online broker of choice. You're not selling on the offer and buying on the bid. You might get some nice price improvement if it's a pretty liquid name and get done somewhere near the middle, maybe a little bit better if you're really lucky, but those moments are really few and far between. So there's a level of accommodation there for the large institutional players that just doesn't exist for the retail. And that's just life, listeners. People who bring large bankrolls to the table will always get preferential treatment. It's just the way the world works. Other things, though, that might surprise you is that for the lion's share of the use cases that we're seeing out there for, large funds and big trading desks and things like that, a lot of their use cases for options, it's not that dissimilar to what the lion's share of the listeners of this program are doing. They're going out there to sell covered calls against equity portfolios to generate income. That's an enormous use case for a lot of the big funds out there who are sitting on stocks. And guess what else they're doing? They're buying puts to hedge those large positions. This became very apparent to me when I transitioned from the index world to the single name equity world, in particular, the large tech names of the time, the Intels and the Microsofts, and to see how one-sided the order flow was in those names was eye-opening. We talk about it, there's obviously a discount to the call wing and a bid to the put wing in most of these large equities and most of these large indices that you're going to trade. But you see it in stark relief when you trade some of these big names out there. What happens in these large names that all these big funds own? Guess what? They're coming in every morning like clockwork. What's the bid on these out-of-the-money calls? Sold to you. What's the offer on these out-of-the-money puts? Guess what? Gonna buy them. And so the skew gets twisted to high heaven, and it was just a process that repeated ad nauseum, almost without respite. It was a challenge from a market-making perspective to be able to deal with that month after month because you knew exactly what was coming. You had to get ahead of it if possible. So what would happen is when the second new months were listed, you had a lot of the traders out there just hitting bids on every call they could find and buying up every put they could find before the customers came in. A little bit of early front running because you knew you needed those arrows in your quiver, those bullets in your gun to be able to survive the onslaught of one-sided paper that was coming your way. And obviously the options market has evolved a wee bit since then, but that still applies. That is still the lion's share of the use case. Now you might say, what about selling puts? We love to sell puts to get into stock positions. Our chat's talking about it right now, selling puts, and looks like some names like Hood and Peloton and a few others out there. You'd be surprised how many funds still don't adopt that very simple use case. I mean, how many times have we said on the show, hey, if you're just selling puts to get into stocks and selling calls to get out of them, you're ahead of the game of a large percentage of the big, quote unquote, sophisticated desks and money out there. But you are. A lot of these funds out there still can't sell puts. They think they're risk additive. They don't understand the mechanism behind it. They're just spooked to do it. They have restrictive covenants in their fund that won't allow them to do that. So even your 10-lot mom and pop trader, they have a little bit more flexibility, a little bit more wherewithal and ability to do some things that some of these large funds still don't do, which is surprising. Dan, what are your thoughts on what I just broke down, the basic use cases for a lot of the big funds out there, and how for a lot of them, they are surprisingly similar to what a lot of our audience is doing?
Yeah, I mean, I think the big takeaway there is that a lot of people who are listening to the show now, I bet that they're surprised to realize that a lot of these big institutions, you think of them as these, big shot professional traders, which they are. But yeah, I mean, a lot of the cases, the majority of the cases, they're doing the same things that you are. They're really good at it. And I know some of you are as well. which is how they're able to keep their jobs, of course, and make a lot of money doing it. But they're selling covered calls. They're selling cash secured puts. Like, they're doing a whole bunch of the same things that you're doing. And man, I think that is surprising for a lot of folks.
Now, don't get me wrong, it's not all the same, listeners. They're doing some funky stuff out there as well. They're using a lot of flex out there these days, which is something, your typical retail. There is more flex access than there ever was before. It's still, for the most part, out of the reach or really the need of most retail customers. I'm hard-pressed to think why a 10-lot retail customer needs a flex position. But that said, if you wanted to do, I think the exchanges would be more open to that conversation than ever before. What are flexes? We've touched on these before in the past. These are just your basic options, just with some non-standard element. It could be a strike price that isn't listed out there. They wanted a custom strike price, let's say XYZ stock. The calls, let's say the strikes end at 50 and they want to sell a 55 call. Well, guess what? They can make that happen when they put up a flex order out there, and they can make whatever strike they want. It could be a non-standard expiration date. Maybe they don't want it going out this Friday. They want it going out on a certain day in October. Whatever the case may be, they can make that happen because they're bringing the size to the table at the end of the day. So they'll get a custom market, and they'll trade somewhere within that. And so that flex utilization is something that's really not a retail use case. That said, flex, like I said, is exploding right now. I'm sure when I go down to OIC next week, a lot of the exchanges is going to be very giddy about talking about flex. What is driving this massive adoption in flex, listeners? It's all these funds that a lot of you retail out there are trading. These funds that incorporate derivatives in some way, shape, or form. These ETFs that provide a high yield and things like that. Guess what? They're using derivatives at the end of the day to do that. And they don't want to sit on a bunch of early exercise risk when they're doing that. So they utilize the flex mechanism to convert those standard listed options that they're trading into European style options that don't have the early exercise risk. So we're seeing a lot of that flow going up right now in flex as a result. So at the end of the day, it's deriving from you folks. You folks out there loving these funds that provide a yield or whatever the case may be is driving a lot of flex flow at the end of the day. Dan, in your long and storied market making career, did you ever trade a flex option? And what are your thoughts about the growing use case for flex? And maybe, who knows, maybe in the near future we will see retail start using these.
As a I never traded a flex as a retail person, but as a professional trader, I know for sure I traded one flex trade. It might have been 2 or 3 at the most in my entire career. They're actually a lot more popular now than they used to be, which is kind of interesting. And yeah, I wonder if it does just have to do with a lot of the users wanting European instead of American exercise style to avoid, whatever tax, losing the stock or whatever. But yeah, it's interesting that they're becoming more popular now. I am still hard pressed to see why a retail person would really care on, like you said, their 10 lot or whatever. I think the people who are using these flex options, the institutional people, they have very, very specific things that they want to do and that they want to hedge. They want to bend the risk of the stock a little bit, the risk profile of the stock. And, they just have certain needs that they have to do. Whereas retail people, you don't really have these certain needs most of the time.
Grandma in Iowa, she don't want to deal with early exercise risk for her 10 lot. Dan, how dare you? How dare you malign her that way? She ain't got time for early exercise risk. She's busy. She's busy slinging her 10 lots, and good for her. Other things that institutions are doing out there, they're using some more exotic options as well. Again, these are not things that retail really has much use for. You may have heard of them, listeners. They're called the various things knockouts or barrier options. These tend to go up on the OTC side a lot out there. They're really designed for very specific use cases that a lot of large institutions have. Maybe they only want to hedge for a very specific strike range or something along those lines. And so they utilize these types of exotic options, which again, for a lot of the retail out there, don't make a lot of sense. We also see them going up in some specific markets. They're more common in things like the FX markets for whatever reason. I'm not sure why knockouts and barriers really became a hot thing there, but that seems to be where they live as well. Dan, have you ever traded a knockout or a barrier option? Do you think is it worth down the road doing an episode on them, or is that too exotic for our audience?
I have never, honestly. I mean, unless I did early on when like Hedge Street or something came out like 20 years ago, I might have farted around with one. But honestly, if we did an episode on them, I would have to refresh myself. But probably our audience would find it interesting. Some members of our audience, I think, would find it interesting. I mean, you're never going to trade one. Probably. But I don't know. I know when I binge on podcasts, not trading podcasts, but other stuff, history nerd stuff or whatever, like take me down all the rabbit holes I can go down. I just want to like soak in everything I can about it. And I think there's members of our audience like that here too.
All right. We'll pencil in a knockout/barrier option rabbit hole, listener. Are you down for that? You want to go down that rabbit hole with us? We can make that happen here on the old OBC. A couple other things to think about here, listeners. Just the differences between institutions and retail. You hear it all the time about the size money that institutions are throwing around out there. But we say it all the time on this network, if you listen to any of our programming, that keys around unusual activity, the odd block segment of the option block, for example, or for our pro members, we do a whole show about it called Options Oddities. What we've been saying since the primordial ooze days of this network over 18 years ago now, wild still to say that out loud, is at the end of the day, the size money is not the smart money. In fact, it's frequently not the smart money. So that's why when you're seeing these big prints go up, it behooves you to really spend a little bit of time digging into them or listen to content like ours where we do a lot of that for you. Because institutions just putting up a massive block, they're buying a ton of calls. Oh, that means they think they want the stock to go up in the near term. Not always the case. They can have a lot of other agendas on. They can obviously have other positions on, maybe OTC, maybe in a different name that they're doing this as a spread against that you obviously wouldn't see. That is frequently the case in the vol space when we see a massive block of VIX options going up. It's traditionally against something else, maybe done in the variant swap market or done in the futures or done somewhere else that very hard to see on the listed side. So that could always be lurking out there. They could have some other agenda that you just don't know about. Maybe they're buying calls, but they're really heavily short the underlying, and they're just buying that call as a worst case scenario hedge against a short squeeze or something like that. We do see that use case quite a bit. That would require a little bit more digging on your part to find out, hey, is this a short sale restricted name? Is this a name that this particular fund maybe is heavily short? A lot of digging is required to find that. Or they could just be playing wrong. We see this all the time. In fact, we had a recent example we talked about on our Options Oddities show on the pro side. We saw a huge block, well over 100,000, I think maybe up to 130, 160,000 of the April 10 calls going up in VOD, Vodafone. And we had seen paper like this in the past on that show around this same time frame in April that had worked out pretty well. So we kept an eye on these. Some of our listeners were trading, and we talked about doing calendars against them to defray some of the cost. There was a lot of interesting analysis going on there. But turned out that 130, 160,000 block of options didn't really work out too well if you just piggybacked on them, because the stock was close to $10 when they went up. I think they traded for around close to a quarter. And then the stock never looked back. Obviously, the tariff sell-off didn't help, and that dragged that stock down. I think it went out somewhere around $8 when the expiration hit, maybe right around $9. So all that premium went to die on the 10 strike, listeners out there. So if you just naked piggybacked on that, you were out of luck. You had to do something else against it, and maybe do a little bit more digging out there. In our case, we did a lot of calendars against it, and it made that trade a little bit more interesting. So again, you see these huge prints going up. Don't just dive right in. Do a little bit of analysis or reach out to a network like ours. Maybe we'll crunch the numbers for you on. We have a whole show. We'll do it again tomorrow with our buddy, the Flow Master. We call him the Flow Master for a reason on the option block tomorrow. So just something to bear in mind. Another good example. We just talked about this week on our option block show on Monday. We saw a huge block of the July 50 calls going up in Springworks Therapeutics Inc., ticker symbol SWTX. We did a little dig and found out they had just been taken over by Merck. They're a pharma name, obviously. So the 50 calls seemed like a weird level for 15 cents, 50,000 times. So it seemed like it was clearly driven by some merger arb trading, probably a little bit of insurance out there. But we put it out to you folks just for fun. Would you like to nibble on some of those, buy some for 15 cents all the way through July as kind of a cheap flyer of this deal going haywire? Or did you not really want to do it because you thought it was just someone who was doing some merger arb, hedging their exposure? And 60% of you said you wanted to nibble on those. You like that nibble, in which case the stock's off a little bit right now, trading 46 1/4, but you got time. You got till July. So some interesting trades and use cases that we see in the institutional side, again, around some of this merger arb as well, that we don't see a lot on the retail side. Mr. Dan, sir, we're kind of already coming up against it for the first half of our doubleheader. So let's take it home. What are your final thoughts and takeaways for our listeners out there on the whole institutional versus retail divide, sir?
Yeah, I mean, it's always interesting listening to stories about, the pros and the people that maybe have different and broader and maybe more experience than what you have in any field. But the reality is, in a lot of cases, they really are just doing the same things. And, they do it so well that they build big funds that can outperform the market or lower risk or improve the Sharpe ratio or whatever metric that keeps them in business and keeps their investors happy. So I guess in a way it should be really, really inspiring, because the things that you're doing can be done really, really well, and you can make a business out of it or just improve your own life standing.
All right, listeners, that is going to do it for episode 1 of our doubleheader extravaganza. If you're hanging out in the pro chat, just hang out. We'll be back instantaneously with more of the Mark and Dan show out there. But before we go, Mr. Dan, if folks want to check out what you got cooking, where should they go? What should they do?
Of course, you can, come to my Substack. I interact there quite a bit. It's wealthbuildingwithoptions.substack.com, wealthbuildingwithoptions.substack.com. Wealthbuildingwithoptions.substack.com is the place to go. We got to get on out of here because we got episode 2 to come, and we got to save Dan's voice. And then we got the futures rundown right after that. So a triple header for all of our pro members today. Should be a fun time. TheOptionsInsider.com/pro. The place to go to participate in all that madness. But now it's time for a double dose of madness. Episode 2 coming at you. Otherwise, for all you on-demand folks, we'll see you next week. Another episode of OBC. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.